Okay. So Donald Trump just said he hopes the stock market crashes in the next 12 months.
We have an economy that's incredible. We have an economy that's so fragile.
Americans are not prepared for the crash that's about to happen.
2024 is going to bring the biggest crash of our lifetime.
I'm expecting a massive crash, and I'm expecting a really, really bad crash.
Occasionally, I get some shorts on my feed of stock market doomsdayers. I'm sure you do too. They state that the crash is imminent and that all indicators point towards an impending crash. In fact, I've been hearing and reading this for years, especially as the market continues on the whole to go very much up. Perhaps it's because it sells or gets its views, but does this argument have its own merit? One video that caught my eye was a gent who claimed that the market was going to crash by at least 80%. Perhaps he pulled this number out of his ass, but it got me thinking, what has the recent history been like? And how volatile has the market dips and corrections actually been? And if we go into a stock market recession, how much would the market dip by? But first we need some background. Average yearly returns have been wild since '09. You may have heard that the S&P 500 returns an average of 10% yearly return. But if you hold these ETFs yourself, these haven't been the numbers that you've been hitting recently, have they? From April 3rd, 2009 to December 2nd, 2024, the S&P 500 has gone up 617.76%. Divide this by 16 years, this is over 38% per year. In contrast, we have periods of times like from May 5th, 2000 to December 7th, 2012, where the market was down by a whole 1%. 12 years of hopeful growth, and the market was down by 1%. Accounting for both of these time frames, it actually averages out to be closer to a 13% yearly gain, with the first 12 years being rather rough, as I previously noted. So let us get to more recent crashes. On December 31st of 2021 to September 30th of 2022, the market dropped by nearly 25%. To get back to its high, it took nearly 2 years. So it took a 9-month drop and a total of a 2-year rebound from the point of high to a point of the high. The COVID crash started around February 14th to March 20th. During this time frame, the market saw about a 31.81 drop, with it plunging as much as 34% total. This drop happened in an astounding 33 days. It is, to date, the fastest bear market in history, and it just took 6 months total for the S&P 500 to bounce back to record highs again. The housing market crash from October 12th, 2007 to March 13th, 2009 experienced a market going down 51.56% over a 1.5-year time frame. While from start to finish, it took 5.5 years, or around April 26, 2013, to get back to the prior pre-crash levels. As for the dot-com bubble, from April 7th, 2000 to September 27th, 2002, the market went down 45.44%. This was almost a 2.5-year period of the market continuing to go down. It took until July 20th, 2007 to get back to prior levels, which happened to be just shortly before the housing market crash. From start to finish, this was roughly a 7-year time frame. I can now understand why, if your first exposure to the stock market and investing was in the early 2000s, and you even stayed for a steady 10 years, why you would remain leery in investing in the market, even after 2010 and being in for 10 years. And I can understand if you started to solidly invest and be able to invest in '09, you probably think you are a genius and you probably are sitting far better financially than your peers. So what are my takeaways? First, are we due for a market correction? Well, the answer is probably, but the question is, what will be the catalyst this time? What will be the bubble that is ready to burst? And how long will it take for the new catalyst to pop? And the answer is, who really knows? Will it be our debt catching up to us? The devaluation of our dollar? New policies such as the tariffs or foreign trade being established? The starting of new world wars? Or even 75% federal government employee layoffs? Now I want to make it clear, I am not arguing for or against any of these things. But the question is will any of this be the bubble that may make the market burst. Secondly, unless the catalyst is extremely catastrophic, I suspect the drop will be nowhere near 80% as some individuals predict. Some individual companies may drop that much, or even certain sectors, depending on the circumstance of said drop, but the S&P 500 will probably only drop 25 to 35% tops, unless the catalyst is something that really changes the workflow, revenue, and total profits of said companies overall. And even if it is a bad case scenario, you need to keep in mind that a 50% drop isn't off the table. And it has practically happened twice in the last 25 years. The third point, I suspect the drops to continue to be quicker and faster, as technology and the spread of information and fear is quicker than ever. But subsequently, the recovery will also continue to be faster than historically seen, as in the dot-com bubble and housing market. Fourth, it takes longer to get back up than the time it took to fall down. In every instant noted above, the recovery takes longer, and I don't see that changing. Finally, and probably most importantly, I could be completely wrong. Perhaps I'm speaking out of my own ass. But what do I know? I was in grade school the last time the market went down 50%. I'm just bummed I couldn't start my professional career in 06, paid off all my student loan debt, and been ready to invest hard in 09, and been part of this 16-year 38% boom. However, regardless of the impending crash threat, I continue to work. Bills have to be paid, and they do not pay themselves. I continue to invest via dollar cost averaging each week in personal retirement accounts and individual brokerage accounts, regardless of what is going on. I remember that timing the market is a losing game, no matter how you look at it. I continue to have and maintain an emergency fund. Life, family, housing, food, healthcare expenses remain expensive, and life happens. I try to have enough margin in my budget so that when the market is having a bad day, a bad week, or a bad month, I am in a position where I can add more to my portfolios. It often isn't as much as I would like, but it is something. Finally, I continue to seek to learn, to grow, and to adapt to an ever-changing world. So what are your thoughts? How off the mark am I? What data are you looking at? And even so, how much does this change your approach? Please let me know in the comments below, and if you've made it this far, please don't forget to like and subscribe. Until next time, juice.